All right, let's get right into it. Something really big is happening right under our noses, at the very foundation of the US financial system. It's creating what's being called the Warsh yield curve trap. So, in this explainer, we're going to break down exactly what that means, and more importantly, why it might just be the newest and biggest risk to your portfolio. And this quote, it gets right to the heart of the matter. The idea that the US Federal Reserve, arguably the most powerful financial institution on the entire planet, is no longer truly independent, well, that's a massive claim. And the first place we're feeling the shockwaves is in the bond market, the one place investors have always run to for safety. Just look at this number for a second. 4.292%. That's the yield on the 10-year US Treasury note. It's the global benchmark, the so-called risk-free rate, that basically sets the price for everything from your mortgage to a car loan. And right now, it's behaving in a way that just doesn't add up. And that's the central mystery we've got to solve. I mean, we've had news that should be good for bonds, like talks about geopolitical de-escalation. Normally, that kind of news makes investors pile into safe treasury bonds, which would push this yield down. But instead, it's just stayed stubbornly high, even creeping up. So what on earth is going on? Well, the market is pricing in a totally new kind of risk, one that has almost nothing to do with economics in the way we usually think about it. And that brings us to our prime suspect, the very real possibility that the Federal Reserve is losing its independence. And look, this isn't some academic debate anymore. It's a real-world risk that markets are actively pricing into every single government bond as we speak. The catalyst, the thing that's kicking all this off, is the potential nomination of Kevin Warsh to be the next chairman of the Fed. His appointment wouldn't just be a small change. It would signal one of the biggest pivots in monetary policy we've seen in decades. And you can bet the market is absolutely scrambling to figure out what it all means. Now, this is where it gets really interesting. On one side, you have the old Fed, the one we all know. It's supposed to be independent, data-dependent. It provided what traders call the Fed put, basically an unspoken promise that if things got really bad, the Fed would step in and support the markets. But on the other side, you have this Warsh pivot. This suggests a Fed that's politically influenced, one that's working under a new Treasury-Fed accord. What that really means is coordinating monetary policy with government spending goals. And that removes the market's safety net and introduces something called regime risk, which is just a fancy way of saying the entire rulebook might be getting thrown out the window. And you can see right here why the market is so spooked. Warsh's ideas seem to be all over the place. He was famous for being an inflation hawk, someone who's tough on inflation, but now he's suddenly a dove, arguing for immediate front-loaded rate cuts, even while inflation is still way too high. His reason? He thinks AI is going to create this massive deflationary wave. But at the exact same time, he also wants to actively sell off the Fed's massive balance sheet, a move that would actually tighten financial conditions. It's this wild, unpredictable mix of policies that's creating so much fear. So, how does all this political drama actually lead to that high bond yield we saw a minute ago? Well, it happens through a mechanism the market has started calling the independence tax. And you can think of this as the weapon that's being pointed directly at bond portfolios. Okay, to get this tax, you first have to understand a concept called the term premium. Think about it like this. If you're going to lock up your money in a bond for 10 years, you want to get paid a little extra for the risk that things could go wrong, right? Like what if inflation suddenly spikes, or the Fed has to hike rates like crazy? That extra payment you demand for taking on that long-term risk, that's the term premium. And this slide lays out the chain reaction perfectly. It starts with the hint of political pressure, which creates huge uncertainty. Investors get nervous. They start asking, will the Fed be forced to keep interest rates low to help the government pay its bills, even if inflation is out of control? And to protect themselves from that brand new political risk, they demand a higher term premium. That extra premium, that surcharge for political meddling, that is the independence tax. And it's not a theory. It's being added to the cost of government debt right now. This simple little formula, it explains absolutely everything. The total yield on a bond, that's R, is basically two things. What the market expects future short-term rates to be, ER, plus that term premium, TP. So here's the trap. Even if everyone thinks the Fed is going to cut rates, the fear of political interference is making that term premium, that TP, explode higher. And that explosion is completely overpowering any expected rate cuts, forcing the total yield to stay high. That's the trap. And we've seen this movie before. History shows us exactly what happens. When you look at what happens after politically motivated central bank appointments, you see a really clear pattern.
In the short term, yeah, real interest rates might fall, which gives this illusion of growth. But right away, expected inflation goes up and the 10-year yield jumps because of that term premium. And in the long run, that's when the real damage shows up. Inflation gets stuck and the yield curve becomes permanently steeper and way more volatile.
Okay, so we've identified the prime suspect and we've identified the weapon. So now let's talk about the casualty. And that's the safe part of your portfolio. Because this whole dynamic has turned a fundamental concept in bond investing, duration, into something that looks a whole lot more like stock market risk. So let's define this real quick. Duration is really just a measure of a bond's sensitivity to interest rates. Think of it like a seesaw. A bond with a high duration is super sensitive. Even a tiny change in interest rates can send its price plunging. A bond with a low duration is much more stable. So the key takeaway is simple. The longer a bond's maturity, the higher its duration, and the bigger the risk. And here it is. This is the brutal truth. An estimated 90% of investors buy bonds for one reason and one reason only: safety. But they are completely ignoring the fact that in this new world, that safety is basically an illusion. This new political risk, this duration risk, can now cause stock market level losses in the quote-unquote safest part of their portfolio. Let's make this real. A 1% or 100 basis point jump in yields isn't some crazy idea anymore. Now, for a short-term bond, that's a manageable 1 or 2% price drop. No big deal. But look at the bottom row. For a long-term treasury, that same 1% increase in yield can cause a catastrophic 10 to 20% collapse in the bond's price. That is a stock market crash level loss from an asset that you bought to keep your money safe. And this is not a drill. This isn't just theory. This chart shows you the shocking reality. In April of 2025, the 30-year U.S. Treasury bond lost nearly 10% of its value in just 48 hours. Now compare that to a major stock market shock, like the S&P 500 dropping almost 20% back in 2018. The safe asset is now giving you losses in the same ballpark as the risky one. The game has totally, completely changed. Okay. Wow, that sounds pretty grim, right? The old rules are clearly being broken. So, what can an investor actually do to navigate this kind of trap? Well, that brings us to the survival guide. The source material really lays out 3 clear strategic shifts. First, think multipolar. If U.S. bonds now have this unique political risk attached to them, it only makes sense to diversify across different global bond markets. Second, you have to deal with the duration problem head-on. Strategists are saying you should probably swap out those long-duration bonds for short-duration ones that can handle the volatility. And finally, it's about looking for totally new sources of income. Some are calling this Yield 3.0. Think about things like private credit or infrastructure debt, alternative ways to get income that aren't so tied to every move the Fed makes. And that leads us to our final and maybe most important question. The entire global financial system, all of it, is built on the idea of a risk-free U.S. Treasury bond. But if that rate now has an independence tax baked into it, a premium for political risk, we have to ask ourselves, is it really risk-free anymore? And what in the world does it mean for all of us if the answer is no? That's the question that's going to define this new era of investing.